Hello and welcome again to our recording on changes in group structure. I'd like to continue on changes in group structure. Before us is the question on Iggy Pop, again parallel universe. At the years that Iggy acquired 80% of Pop for $200 million. Fair value of the identifiable net assets of Pop at the time or point of acquisition was 90 million. The fair value of NCI is 39. We're required to do goodwill. And then we are told that at the end, Iggy acquires a further 10% interest in Pop for 29 million. Pop has made profits and grown by 10 million over the year, and therefore the carrying value of the identifiable net assets of Pop now stands at 10 million at the end. You're required to show the effects of this change in group structure on the controlling interest. Alright, whether the controlling interest made profits or loss as a result of acquiring further 10% in Pop. Let us do the work. Again, when it comes to goodwill, this is Iggy Pop. Alright, parallel universe. I would like to state that you would do well to start with a basic format of your goodwill computation. So fair value of cost of investment with fair value of NCI, and then you also have to less net assets, alright, at acquisition. Alright, so if we look at our work, look at our question, we shall discover that really we have got a 200 as cost of investment. It's not as difficult as one would expect. There's a 39 for NCI, and net assets we are valued at that much. Alright, so when you do your summation, you will be getting the figure for goodwill, which is 149, right, at acquisition, of course. Now we want to show also the effects of this on NCI, effects on both NCI, of course, and controlling interest. So before this happened, NCI is said to be valued at the value of NCI at acquisition. Alright, then you open brackets and you say the company made, subsidiary made 10 million shares, $10 million rather, in terms of profits, and of that 10 million, 20% belongs to NCI. Alright, when you do your maths, of course, for the sake of understanding, I could do this. Some of us we are getting a 41 there. Alright, and then we are told that there's a 10% interest acquired in NCI, from NCI. Alright, so how do we work out that one? Shouldn't be difficult, I think. You get the same 10%, you divide it by NCI percentage, then you multiply that by the $41 million. I think that should not be very difficult. Again, when you do the work, you should be finding that figure there. So therefore, if NCI gave up 10%, then it has to reduce. So after what is the value of NCI after this particular acquisition in by parent of a further 10%. We have that figure there. Alright, and then we have to consider effects on controlling interest of this particular transaction. Now, parent paid, alright, how much for that interest? Parent paid a 29 million. Alright, and then we got the 10% interest. Can I write it just the way it is? Let me just try to do this. Copy that and push it where it belongs. 10% interest acquired is only that much. Alright, we paid 29, we are getting shares with a value of 20.5. I think we are making a loss. How much is the loss? Yes, it is 8.5. So that's what we have there. I hope that you have gotten one or two things from here. I'd like to go now to Buster Rhymes. Buster Rhymes question again, and again it starts with the issue of Voodoo. So I'd like to just get that one, push it where it belongs, and of course we can discuss other things. Alright, let's go to Buster Rhymes and see what is happening there. At the year start, Buster Rhymes acquired 90% of Rhymes. Buster acquired 90% of Rhymes for 440. Fair value of the identifiable net assets of Rhymes at this point of acquisition was 180 million. Fair value of NCI was 40. Goodwill has to be calculated, which I've already put the format down there. At the end, Buster disposes 15% of the equity of Rhymes, meaning that we are dropping to 75%. And we sold that interest of 15% at 90 million. Rhymes has made profits and grown by 40 million over the year, and therefore the current value of identifiable net assets of Rhymes is 220 million at the end. Required, show the effects of NCI as well as controlling interest, this particular move. So again, we have to be disciplined. We run with the figures that have been given. Cost of consideration for 90% interest in Rhymes was that. NCI was that figure. The identifiable net assets was valued at that at acquisition. Therefore, this is our goodwill at acquisition. Alright. Now, there are several ways in which, of course, one could run with this particular question. This time around, I'd like to introduce a different view. How are we going to value the disposed interest? Value this is 15%. Disposed interest in Rhymes. Alright, I think we can do that. So how does that look? It looks as follows. We have yes, we do have our net assets, which has been given in the question. If I may go there, at reporting 220 plus our goodwill, which we found to be 300. So the total value of Rhymes at the reporting date was that much. Alright, and then we disposed of 15% interest. How much is that showing us? So again, that gives us a 78. That's the value of the transfer. Okay. Once we are done with that, now we compare again. We say establish profit or loss on transfer or disposal of these shares. I think it's not very difficult to do. So what you do is you consider the money received. You received 90, then you sold, okay, value of disposed interests. And in this case again, we have to be honest, 78. I think we made a profit. Profits of 12. I hope that you can see that. That's what we needed to do there. I hope that you can come up with your own questions. I would like you to practice these questions: stop, toy, love, rock, and so on and so forth. All right, so that you can have a grip on these issues to deal with group structure changes. I want us to go to a brief discussion on joint operations and joint ventures. In a J or a joint operation, two individuals share control of the operation, but assets are not jointly owned. The accounting follows the substance. So the interest under a joint operation arrangement is returns. How do we share the returns? Then in a joint venture, in a JV, you and I, or two or more individuals, share control over everything else, including assets. I hope that you're seeing that, and please follow it up with the discussion that was made here. There's a good example there. I would like us to go straight to this question called Freddie. Try to do some bit of work. Then afterwards we can close. I'll be sending you more work. All right. So let me go to the requirement. Prepare the consolidated income statement for the year ended 31st December. We are told the following question looks at the disposal in the context of income statement. On 1st January 4 years ago, Freddie acquired 80% of the shares of Mercury for 500,000. Mercury had share capital of 100,000 then and had reserves of 200. No shares have been issued since acquisition. At acquisition, the fair value of the net assets was 320 at acquisition. All right. The fair value of adjustments related to inventory. I hope that you can see that. So I'd like you, the fair value of the net adjustment related to inventory that was sold immediately after the acquisition. So we need to insert that as a balancing figure. I'll show you how to do that when we get to that place. Goodwill has been tested for impairment at each year, and since acquisition, no goodwill has been impaired. Since then, it is the group's policy to value the non-controlling interests fair value, which at acquisition was 103. The income statement for the year 31st December in the current year is given below. All right, now we are told down there, we just run through that. Freddie sold half of its holding in Mercury on 1st January. So we are dropping from 80% to 40%, from control to associate status. All right, Freddie received cash proceeds for 30, but this has been recorded in a suspense account on the statement of financial position. The group accounts of Freddie Group has been prepared and are presented above. However, the accounts of Mercury, all right, have been prepared. However, the accounts of Mercury rather have not been consolidated because of the media disposal. Freddie retains influence over Mercury Vice remaining shareholding. The fair value of the associate is now measured at 420 at disposal. Mercury paid an interim dividend, all right, in cash on 7th April in the current year, prior to the disposal. Prepare consolidated statement. So again, this figure is to be taken as an intra-group dividend, which is never recognized as far as groups is concerned. So let us deal with the workings. I'm dealing with Freddie here. How does that look? I think that's the way it's supposed to. All right, so what do we have? Working 1, dealing with net assets for SAB. What do I have? We have those amounts there. Just have to change that. Again, net assets simply means capital plus reserves. Where are we? And reserves. All right, so for the capital aspect, I think we can go top here. We can see 100 shares in the SAB, and also there we have got that. All right, that's what you have. Then we also have our reserves. We are told in the note again that the reserves for Mercury was that. I hope that you can see that. Then what else do we have? We have the issue to deal with the reserves of the reporting date, and that's where we need to be a little bit careful with what we are going to discuss. All right, so let me because here we want to discover the 6 months, the reserve 6 months in the year. Remember that we have only to consolidate up to 6 months, because afterwards we drop to associate status. Once that is clear, then we can run with that. So let me just do some bit of working here. Initially, when you look at your work here, opening retained earnings at the current year start is shown here as a 340. Remember, this is 4 years. When you're talking about 200 here, you're dealing with 4 years ago. But now we have had some profits that were made, hopefully. And that's the reason why we have got that figure. So we go get that figure, and then we say 340 plus. We get back, we say we need half of the profits after the acquisition period, which is up to the date, rather, when you dispose of the 40% interest. So I hope that you can see 100 here. It's that 100 that we're going to run with. Say 6 divide by 12, multiply that by 100. Of course, that's a 50. And then you say we are also cognizant of the fact that there was the issue of interim dividends. All right, but then in our case, normally this is not to be recognized, so we are going to reverse that, say minus 20. When you do your maths, you will be getting 340 plus 50. That's 390 minus 20. That gives us 370. So let us sum up. I've got the figure there, and also the other side I've got that figure. So when I consider that, I go down here, say let me work on my goodwill now. Working 2. Remember, this is income statement, so we may not have the traditional 6 workings. Alright, so again, cost of investment. Remember your goodwill fair value of NCI, and then we have got less net assets at acquisition. Right, at acquisition. Right, there we go. So let's begin. We are told that we acquired these shares for about 500. So I'll put my 500 there. We're also told that NCI was 10103. There it is. I'll put that figure there. And then I'll less what I've just worked out on top there. When I add, I get, was that supposed to be like that? Alright, we've got a small challenge here. We are told that, let me just correct that. Let me just push that one down there. There is a note that must be given attention. We are told that no shares have been issued since acquisition. At acquisition, the fair value of the net assets was 320. The fair value adjustment relates to inventory. Alright, so let's get back there. I would like us to revise that figure. And then we say, when we find the difference between 320 and the amounts above, we are likely to get a 20. And I just want to announce that these sort of adjustments will meet them in most of our workings. So I'd like to change that as well. I overlooked that, but this was just something that was brought in the question. Alright, we were supposed to consider that and find that as a balancing figure. Please, let's remember that. Alright, balancing figure. Okay, we almost there. So our goodwill has been established. Now let us deal with the issue of the disposal. This is working 3, disposal. Disposal. Did we make a profit or loss on this particular disposal of our 40% interest? Okay, that remains to be seen. So let us do some bit of work. The deemed or sale proceeds for the interest, 40%, sale proceeds for the 40% interest stands at how much? Let's go to the reference evidence. Is very important. 430. So you push it there. 430. All right. What else do you have? Then we have got what we call deemed proceeds. This is the value of the remaining 40%. All right. The value of the remaining 40%, it is 420. I hope you can see that. All right, so 420. And then we are told NCI has to be calculated. You need to remember NCI will have to be calculated. So what was the NCI initially? 103, that's correct. Plus, open brackets, and then you say the post-acquisition profit 470 minus 320. Multiply that by the rate, the new figure is at 20%. How much do we have? We are getting a 133, of course. Then we less. Remember, this time around, goodwill has to go as well. We have crossed the threshold. So less net assets at reporting. Okay, net assets at reporting. I'd like you to complete this question once we are done. So that shows on top there, that's a 470. And then we also less goodwill. What do you have there? Goodwill standing at 283 minus 283, that figure there. So we sum up, we get a positive, which is a profit, and that's the figure that we're looking for. All right, so thank you very much for paying attention. I would like to challenge you now to do consolidation. The hints are as follows. The figures for Mercury must be prorated over 6 months because we only held or had control over Mercury for only 6 months. The 230 gain, which we have just found here, should be treated as a disposal gain. Please, let's push that one just below the net profit. Please do not forget to calculate your profit for associates. I think the rest remains the same. I'd like to thank you for listening. Hope to